Assalamu alaikum. Welcome back to the second part of the chapter number one. As we have discussed in chapter number one, in part number one, about the fundamental analysis of a trading, and as well as about technical analysis, and as well as we have said that Mark Douglas is mainly focused highly. He said mental analysis is the vital among the all analysis. Now, moving on to the next lecture, which is about the illusion of knowledge. Now, when we say about illusion of knowledge, now what does it mean by that illusion? And now, in illusion of knowledge, we can say misperception regarding trading. We can say that traders, that's a belief that many traders like a, as a belief that many traders believe more knowledge ensure success. Now it means that the more you have knowledge about the market, and the more you will be a successful trader. Now that's a kind of illusion, or we can say there's a myth, or it's not real. Now why it's not real, I'll tell you. One thing is clear: no matter how much you know about the market, no matter how much you know about the market, but still the market's uncertain, is still uncertain. No matter whatever the more knowledge you gain about the market, but still it is uncertain. It helps you about the to gain about to getting knowledge about the market, to know about what's going to happen. But still, it's not, you cannot predict that 100% yes, it's going according to your point of view. That's why we can say that it is uncertain. So the belief that the more you gain the knowledge about the market, but the market still will be uncertain. So anytime it makes you wrong, anytime it means you have done your calculations, everything say every of your whatever you have done, your calculations say that 100% the market will from here is go up, or from here is go down. Now eventually in that point something else happened. Yes, different things happen. Now that's why you say the market is uncertain. Now number two is that the market is uncertain. It cannot uncertain cannot be eliminated through analysis. So do not be depending too much on your you know knowledge or whatever you know about the market, because it's always uncertain. What anything can happen. But only control lies about the market. Where? In your own behavior. Now the true control lies only in managing on your reactions, your behavior. There. Whatever happens in the market, it won't affect on you. Traders, those people who are the risk taker and they are the traders, they sit back, relax, whatever happens. They'll not get a panic. So that's why I'm saying the illusion, it doesn't mean that the more you have knowledge and the more you know about the market and you have the control of the market. No, that's completely wrong. No one has the control over the market. It can happen. You can, you know, when you take a decision, the decision should be on the basis of certainty. Like maybe happen, maybe, but there is no assurance. You cannot assure something that yes is going to be happen like this is 100% bad, 100%, unless until you're a huge trader. Yeah, it's happened. Then it can be a loss of thing can happen. because a loss of big traders who are in the market who can manipulate the market. But individual person cannot do anything. Definitely those who have, they definitely have the huge backup too. Individual cannot be manipulated according to his analysis or something, but or you cannot control it. But a group of people, they may. Like last time when US Trump has made a decision, or he came to that with a decision that 100% tariff on China products. Those who are exporting from the China, and they have to pay 100% tariff. Now, see, the market goes down. It's completely down, and the share price of the all, like from take it from the Amazon, the share price goes to down, came to the level, the lowest level. Why? Yes, that's about the government decisions, not individual decision. That's the government decisions, which control the huge, you know, the huge market, the whole market, the whole Wall Street market. So you can say now the importance of self-management. The importance of self-management, you can say, trading is mental discipline above all. See, trading is what? Is a mental discipline above all. Common common emotional pitfalls. What are the common emotions of pitfalls? Is number one, fear, greed, overconfident, and revenge trading. Now, four things are there. Number one, fear. Why we feel fear inside the market? Fear of losing money. Exactly. When you go with a trade, you invest or you take a trade, and you have inside the when you have got fear inside your heart of losing money, so definitely you'll lose that. That's why we can say that traders, they're not be they can't be, like they are fearless. Traders are fearless. They don't care whatever happens, wherever the market goes. They 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 stuck to their decision that what they have made. If they loss. If they win. But they never make their win to loss. But they make their loss to win. But they never make their loss to win. So their win to loss. Whenever they are winning in the market, they take their and they're waiting for the next opportunity. The next one, the greediness. Greed. Now, it is clear that whatever the market gives you, take it. If you make a profit of 2% or 3% or 5%, take it and get out from the market. Now, don't stuck yourself there and staying there. Oh, I make this profit now, let it go to 6% to 10% or from. Now, I told you the market is uncertain. No one knows what will gonna happen. No one knows what next candle will be, because it's based on, market runs on the base of your emotions, not on the base of your what you think, like on your own feelings. No, doesn't depends on your own individual feelings. It's the base of collective emotions. You need to understand, but we have, you know, your greediness. You need to control over the greediness. Whatever the market gives you, take it. Is give you 2%, take it and move on. If you give you 10%, take it and close the machine and go, and come next day. The next one is overconfidence. Overconfidence, what happened? sometimes it happens that you make a trade once, twice, and third time. That's your winning strike. Your winning strike goes up. Now from here you believe, oh, I crack, and you're going with the higher money, and that's the point when you are coming down. Don't think that's a gambling. Don't think it's a gambling. No, don't come up with a gambling attitude inside the trading. When you are when you are not following your technicality or methodology, whatever your strategy is, you're not following that, and you are bypassing your strategy and you are doing something else. It's overconfidence. Yes, I'm gonna win. I'm gonna say. So that's what overconfidence always. It's also for put you down sometimes. Now another one, revenge trading. Revenge trading is the biggest problem. When you lost your 5% of your investment, now for the recovery of that 5%, you do again, you are entering the market again and trying to recover the 5%, but you're losing 10% of your income again. Now again don't go with the revenge. Once you have lost, now because of your attitude, and you have the attitude that you are getting your money back, no, stop from there and lock it. Now think about that day. That day is not your day. Come the next day. Think about that. That day is not your day. Let's say you make a loss. Yeah, stop from there. Because of that. So revenge trading. Avoid revenge trading. Now success depends on what? On self-control, on objective decision making. Objective decision making. Now self-control. When you have no fear, when you have no greediness, and when you are making decision not over on your own, like without any proper strategizing the market, and you're going to, and that you're overconfident about it. You said, oh, sometimes it happens. Now when you are making decisions on the basis of proper analysis, proper observations, and you seeing things, you observe the chart, you can see that these possibilities are there. Now you are entering, you believe, yeah, there's possibilities. It means that 80-20, maybe 80% your decision goes toward you, or 20% goes toward the negative, but still there's 80% of your decision is on your side. So that's what when you go with the objective decision making rather than with the subjective ones. So avoid these things, so then you will be control, and then you will be calm, and you will be able to trade actively in the market. Now again, the next one we have the trap of expectations. The trap of expectations. Now expecting every trade. Now these are the trap of expectations. What I told you at the beginning, your intention matters a lot. Your intention matters a lot of trading. Why you are trading, why you are inside the trading. Is it you came for the quick money? Then you are wrong, because it is a proper, it's not a kind of market that you are coming and getting money and quick money and boom. No, it's proper strategize and going with the disciplined. That's why we can say that Expecting every trade to be profitable leads to frustrations. Now, when you are coming to the market and you believe that, okay, every trade will be profitable, now that will be an insane. How can what are your expectation? Your every trade should be a profitable? I know that you expect, everyone expect. Now, when your one trade is profitable and the next trade goes to the losses and the third trade goes to the losses, now you become frustrations. Now you're frustrated that why my trade is going to earn losses. Now that is what we can say, that the trap of expectation is what then you are going toward the losses rather than, because you are not made for the market. If you have angerness or you have like frustrations, problem of frustration, and you don't have a control on yourself, so don't enter to the market of trading market, because trading needs from you what? Calmness, relax, focus, strategy, understanding. I said earlier that knowledge, like illusion, like to getting to know about too much about the market, it doesn't mean that knowledge is not enough. You need to understand the fundamentals. You need to understand the charts. You have to see that charts, what it tells you. You know about the indicators. At least you know about all the things that you have, and you have confidence on your decisions rather than confidence on your expectations. Why are you expecting from the market that the market will give you and give you return all the time to profit? Because the market will give you anything, whether it give you profit or whether you give you losses. You have to accept both. You can't accept one or reject another one. You have to accept the both. Then if the market will give you them. If you believe that okay, the market is now I'm getting profit, I'm happy. If you're not getting profit and you are frustrations and you become angerness and you blaming the market, so because the market's not going according to you. No, be relaxed, be calm, strategize, understand yourself, understand your market, whatever shares you are buying, study about it, study about the market. Really, now understand about the news of the news related to your shares you want to buy, and see, consistently observe the market of that, see the liquidity ratio of that, so where the market lies, the graph, the charts, everything, properly understand that, then into the market, then decide and sit back relaxedly. But always try to, when you enter the market, don't enter the market with your with the money which spare that you don't need it, not with the money that you have borrowed from somebody and you came to the invest and you are invested, and the next day they're asking for the money. No, something from your own that you have, that's related to you, and that you can play with that money into the market. No pressure of somebody else. Now, that's my personal opinion. And the third one, second one, consistency arises from the discipline, execution, not from the productions. Now, again, your consistency arises from the discipline. Now, discipline is, what is discipline? We can say how discipline executions. Once you made a strategy that this is my indicators, indicator 1, 2, 3, and this is my, on the base of these numbers, on these uh, indicators that I have put, this 1, 2, 3, 4, 5 indicators that I'm using for analysis of the market. Okay, on the base of this market, if the price comes here, and I'll buy. If a price come here, and I'll sell. Now you stuck on your decisions. Now whatever happens, you are not breaking your own rules. Now then you will be able to make the profit, and you are executing your decisions, and you cannot, not on the basis of predictions. Oh, this is going to happen. Now discipline comes with the executions, not from the predictions. Now the last one, trader rule role is to execute their each without emotional influence. Now, when you are coming to the market, investing in buying or share of the company, so that share, buying the shares of the company is depending on your studies, on your observations, on analysis, rather than on your emotional preferences. So keep your emotions aside from the market. The more your emotions, keeping your emotions aside from the market, the more you will be calm and relaxed and focus on the market to earn money. Because you are entering the market for the earning money rather than for playing with your emotions. When you take a decision on emotional base, you will be fall down. If you make a decision on the base of your objective base, you understand the market, you see, you observe the strategy, observe the market, where the market goes, so then it will be able to give you return. The market will be able to give you return rather than give you losses. Now, emotionally coming to the market and playing, or because of the, like when the market goes up, you become happy. When the market goes down, you become sad. Now, see, changing the market affect only changing your behavior or in your in moods. So that's not a trader. So he or she should not be like this. So whatever happens, once you enter the market, once you invest it, no matter happen, you need to be calm and believe on your strategy that you have used it. Now, the next one is what? Acceptance. And I said at the beginning, how you can be calm, how you can be relaxed, how you can be out of the frustrations, out of the greediness, out of all these, and you how you can be focused once you accept the risk. Once you accept the risk and you said that this risk is, and I am the risk taker, no matter what happens, no matter what happens, I'm okay with the anything happens in the market. Because once you accept the risk and you believe that I'm a risk taker, so that gives you freedom. It gives you freedom. Now that's why we can say accepting risk creates emotional freedoms. Because then once you accept the risk, once you accept the losses, so what will be happen? Ultimately what happening in the market? Loss now. And you accept the loss. I said whatever happens, I accept. So then whatever happens, I accept the losses. Now once you accept the losses, and that's only the fear that you have. So if you accept the losses, there will be no fear. Everything will be normal and will be relax. Now see, then it becomes, once you accept the risk, you become normal, and now losses, the losses that you're doing, the market goes up and down about your losses, that becomes normal for you. That's become normal. That losses are normal, a part of the trading probabilities. Now you decided the market goes up, now it goes down, and you make, on your stop losses, all definitely you say on the stop, you put the stop losses, you make sure that managing your risk is also important. Now stop loss, you lost it. Now what happened? It's fine, normal. Now you're going again, you analyze, and going, you again you study, again you analyze the market and observe and waiting for the next trade. Now the next one, objective thinking, emerges only when the risk is fully accepted. Once you accepted the risk fully, your mentalness, your attitude will be very strategized toward the market, and you're fully calm, and nothing will happen to you. And because once you accept the risk, you become relaxed. That's what the acceptance of the risk is. Because I said market is a risk. Market is a trading is a risky. It is a risky. If you are entering the market, you are a risk taker. So if you are a risk taker, yes, say that, yes, I'm a risk taker. Because risk taker is always facing losses. Now, be ready for that. Once you're ready for anything happen in the markets, and now then you'll be relaxed. That's it. Then you will be saying that, oh, it's a part of the market. It comes and goes. Sometimes losses, sometimes profit. Rather than it's change your moods. Now, they say that again. The core lesson for chapter number 1 is